welcome to The Explainer. I am so glad you're here. If you've ever looked at a corporate annual report and just felt completely overwhelmed by all the financial jargon, you are in the exact right place. Today, we're acting as your personal mentor to unpack BUA Cement's 2025 annual report. We're going to strip away the complex terminology and look at exactly what these numbers mean for you as a retail investor, plain and simple.
Okay, let's dive into this. Right off the bat, before we even look at a single spreadsheet, let's ground ourselves in reality. This is BUA's cement plant operating deep into the night. It is incredibly easy to get lost in the billions and trillions on a balance sheet and kind of forget what you're actually buying into. When you invest in this company, you aren't just buying a ticker symbol, you're buying into a massive, 24/7 physical operation, churning out the building blocks of infrastructure. Grounding ourselves in this physical reality makes the financial numbers we're about to see make a whole lot more sense.
Here's our investment map for today. We'll be covering 1. The 2025 scorecard, 2. The currency factor, 3. FX impact on margins, 4. Investment horizons, and 5. Growth indicators. Let's get started. Starting off with Section 1, BUA Cement's 2025 scorecard, a record-breaking year.
And wow, this brilliantly illustrates exactly what top-line health looks like. Just look at that leap. We're looking at a jump from 73.9 billion naira in 2024 all the way up to 356 billion naira in 2025. That is a staggering 381% jump in profit after tax in just one single year. For your portfolio, this signals an incredibly robust underlying business model that's successfully scaling up its operations and really capitalizing on market demand.
Now, to fuel that kind of profit, you need monumental sales. And here, we're talking about a massive 1.2 trillion naira in revenue. Crossing this threshold is a historic milestone for BUA Cement. But as an informed investor, seeing massive revenue is really only chapter 1 of the story. To understand how much of that cash actually stays in the business, we absolutely must look at the external economic factors acting on it.
Which brings us to Section 2, the currency exchange factor, navigating the elements. Okay, so to understand the macroeconomic weather that affects every single Nigerian business, we need to talk about foreign exchange. Think of it as a two pockets analogy. Imagine you need US dollars to buy spare parts for your cement kilns. Well, you've got two places to go. The first pocket is the official Central Bank of Nigeria counter. It has a slightly lower price, sure, but there's strict rules, lots of paperwork, and sometimes a very long line. The second pocket is the black market, or parallel market. It's instantly accessible, you can get your dollars right now, but you are definitely going to pay a premium for that speed and availability.
Let's look at the actual numbers shaping this dynamic. On one side, we've got the official CBN rate sitting at 1,373 naira to the dollar. On the flip side, the black market sell rate sits at 1,397 naira. Now, this gap isn't arbitrary at all. It exists purely due to the realities of supply and demand outside the regulated banking system. When everyday traders or massive corporations need dollars urgently and the official lines are just too long, they turn to the parallel market. And that high demand, it drives the price up.
Let's move to Section 3, FX impact on your profits, a margin squeeze scenario.
Let me walk you through a really simple scenario so you can see exactly what this means for your portfolio. Step 1, your cement company earns 1 million naira in local sales. Great, right? But step 2, a machine breaks down and you need $500 for an imported spare part. If you simply can't wait around for the official bank rate, you hit step 3. You buy dollars at the higher black market rate. Suddenly, the naira cost of that single spare part spikes. You're still making the exact same amount of cement, but your expenses just went up purely because of the currency exchange. That dynamic acts as a hidden tax, shrinking the actual profit margin that eventually gets passed down to investors like you.
And hey, this isn't just theory. It is a massive focus at the highest levels of the company. As the chairman noted in the annual report, the stabilization of the naira contributed positively to predictability in planning and reduced volatility in finance costs. BUA Cement's leadership actively monitors this exact currency volatility because they know, for a fact, that stabilizing those finance costs is the ultimate key to protecting your shareholder value.
Next up, Section 4, Investment Horizons Explained, the road ahead.
Let's map this all out. In the short term, you might see some volatility. The company is actively managing its FX exposure and taking on debt to grow. That's going to cause some bumps. But look at the midterm. The focus shifts to stabilization as they scale up their new liquefied natural gas, or LNG, power plants to cut energy costs. Finally, looking at the long term, all this infrastructure pays off. Their massive 9 million metric tons per annum capacity will be fully operational, and that is designed to secure and sustain future dividends for you. And the real beauty of this? It's not just some pipe dream on paper. This timeline perfectly illustrates that BUA's mid- and long-term expansion plans are physically in motion right now. From 2023 through 2025, they've been rapidly commissioning 70-megawatt gas power plants and multiple new 3 million-ton lines at Sokoto and Obu. The actual infrastructure to support that long-term vision is already built and firing up as we speak.
Which brings us to our final section, Section 5, Growth Indicators to Watch, your future checklist.
So the crucial point here is that as a retail investor, you really only need to track 3 vital indicators going forward. First, energy transition progress. Are they continuing to shift to LNG to keep operating costs low? Second, capacity utilization. They built a massive 9 million ton capacity, but are they selling enough cement to actually maximize it? And third, FX debt management. Are they keeping their borrowed money, specifically their gearing ratio, under strict control?
Now, what's really interesting about this is that dramatic 37% figure. BUA Cement actually dropped their gearing ratio, which, by the way, is essentially a measure of their financial leverage and debt, from a really high 127% down to an incredibly healthy 37% in 2025. They are actively paying down their obligations and managing their FX debt, which drastically lowers the risk profile for anyone holding their stock. That's a huge win.
We've covered a lot of ground today, but just look at what you've achieved. Knowledge truly is your greatest asset here. By understanding the real-world physical operations, the staggering revenue jumps, and exactly how FX rates act as a hidden variable on corporate profits, you're no longer a novice. You now have the actual tools to read a complex annual report and decode the real story, just like a seasoned pro.
You've seen the impressive, record-breaking profits, and you understand the real economic hurdles of foreign exchange that this company has to navigate every single day. You know their roadmap for the future. So I'll leave you with this thought. Now that you understand the mechanics behind the curtain, what is your personal risk appetite for the road ahead? Think about it, and we'll see you on the next explainer.